Yeah, there's no doubt. It sort of changed the mood of the market and, as Ed says, around 11% of the market. So soaring commodity prices, and notably iron ore, have pushed BHP to a record half-year profit of almost $10 billion US. In the past year, BHP has delisted its shares from the London Stock Exchange and is in the process of a $40 billion merger of its oil and gas assets with Woodside Petroleum. BHP's revenue in the half year climbed almost 30% to around $30 billion US. That came as it shipped more than 129 million tonnes of iron ore in that period. Profit after tax came in around $9.5 billion US, more than doubling. That's up 144%. You can see it also paid a record dividend, $1.50 US a share, with a total return to shareholders more than $22 billion in the last year and a half. Joining me now from its Melbourne headquarters, BHP's Chief Financial Officer, David Lamont. Now, David, it's been called the third great transformation of BHP in some ways. The philosophy now seems to be to mine the commodities to help power and feed communities in a growing but lower carbon world. Is that how you sense the philosophy of BHP's mining in the future?
Look, Ross, certainly what we do see is that we have a portfolio that's well placed to play into some of those mega trends that are happening globally. Now, whether that's decarbonisation, whether that's higher living standards, or whether that's also how we feed the world moving forward, we do see that the portfolio of assets that we have puts us in a very strong position to ensure that we actually are able to return significant amounts of money to shareholders, as we have just done in the 6 months just finished.
Yeah, and that's certainly the case. I mean, the dividends have certainly exceeded expectations, the amount of cash coming off it. Just tell me about the future of iron ore prices, because even in the report today, you do raise some question marks about whether the growth that's been seen so far can continue on the same trajectory it has.
Yes, so certainly what we have said about iron ore prices and commodity prices more across the board is there has been volatility. If you go back 6 months, we certainly saw iron ore prices below $100 a tonne, and today, let's call it nudging $150 a tonne. So what we are seeing is strong underlying fundamentals for the demand for iron ore playing out through China primarily, and the rebound that we've seen there in the real estate market, also in relation to access to credit, that is helping that underlying picture for steel growth. Now, iron ore prices obviously benefit from that, but I'll also just reference also our metallurgical coal, where we did see that the prices in this 6 month period were triple those that they were the same period last year. So the steel industry is certainly helping us, and our focus, though, is how do we ensure that we continue to operate reliably at the bottom end of the cost curve.
Yeah, I was going to say, because that's the key, isn't it? Trying to keep your costs under control, which means your mining practices, your industrial relation practices. But people are now talking about labour shortages, about even the impact of COVID inside some of the mining operations in Western Australia. Just how do you maintain those very high margins and those low costs under those sort of conditions?
Yeah, so it's about discipline, Ross, into that overall picture. Let me just take you to, we saw 15 to 20% absenteeism on the eastern seaboard of Australia into our coal operations, but we were able to continue to operate effectively through that. Jump across to Chile and our operations in Escondida. At the start of the pandemic, we were seeing similar sorts of things, up to 30%. Playing out in restriction of labour. So we think we've got some really strong lessons to be applied. Certainly over in Western Australia and in the iron ore operation, great credit to the team over there to be resilient enough to continue to produce the output that we have, almost record production out of WA. So we think we've got some sound learnings that we can apply to the ongoing situation with COVID.
Just tell me about WA and the border restrictions that are there and operating. Does it make it more difficult to run your operations as you have to, given those border restrictions?
So it does make it more difficult, but I will start with, we also want to operate safely. So we understand the restrictions that we'll put in place to ensure the health of the Western Australian community. And from our side of things, it has put some pressure in, largely around skills and shortages, but we've been able to manage our way through that. And as I said, we are applying some of the learnings that we've seen elsewhere across our operations to the WA situation.
So I just want to go back to one aspect you mentioned earlier, and that is metallurgical coals. There are record levels. Of course, that's used in the steelmaking process, unlike energy coal, which BHP has moved itself out of, which is used in electricity generation. Just one thing about this, the metallurgical coal, you've also sold off some of those mines. But given the fact that there is no viable alternative at this stage to steelmaking, why would you actually move out of those assets, especially when they're as high as they are?
So, Ross, we very much wanted to focus on the premium, the hard coking coal side of our operations, and that's largely the assets that we have in our BMA business. What we did sell was our BMC assets, which were lower grade and also down into some thermal coals that we've also got out of. So we are very much supportive of hard coking coal, the premium hard coking coal, as you said, that goes into steel manufacturing. And we see that that is a resilient part of the business moving forward.
David Lamont, Chief Financial Officer of BHP. Great to chat to you on the program today.